Okay, so we continue with the operating statement. This time around, we start with SC. Okay, so let's go. Operating statement. So Mr. Kasia? Excuse me. Mr. Kasia?
Yes, yes.
Mr. Kasia, you've been quiet for a very long time today. Is everything okay?
No, everything is fine. So that is cutting me. Somehow my network is not fine today.
Okay, organize the MiFi. It is faster.
Oh, yeah.
Okay, sure. Mr. Mfune, everything okay?
Yeah, very okay. Very much okay.
Sure, sure. Thank you very much. So we can move on. Professor, are we okay? Professor, are we okay?
Good.
Madam Emma, are we okay?
Yes.
All right. Okay. So let's move on with our operating statements. Now we are looking at AC method. So number one, operating statement. Now here, what we want to tell you is this. The operating statement, sometimes the examiner asks you that, I want to mention here that there are several ways in which an operating statement may be presented. For example, the most common format is one which reconciles budgeted profit to actual profit. So you're going to see the common format for this one, for operating statement, there's a common format. Now the common format here, it reconciles. You see something like this one reconciles the budgeted profit to the actual profit. This is the most common one. Okay, so there we go. So here, let's begin. So now in this in this question we are dealing with, you've seen that the sales and the admin costs, they are going to be introduced because now we want to reconcile the costs now. So what do we do? So let me just erase these guys here so that I can write properly on the full board. So without wasting much of the time, we'll go straight into what you should do in the exam. So on that Tuesday morning, when you'll be writing this paper, this is what you should do. Number one, just write budgeted. So if you are dealing with AC, then we go with the budgeted profit, not the budgeted contribution. Have you seen? AC use BP. Have you seen? Use budgeted profit. So what is our budgeted profit in this question? Our budgeted profit is easy to calculate because we have a standard profit. You see? The planned profit. So how much was our planned profit? How much was our contribution? How much was our standard profit? Our
Standard profit is
our budget production was how much? Was 5,100. You see? Then you multiply by the standard profit of how much? Of 6 kwacha per unit. Which means the profit that we have is how much now?
30,600.
30,600. If you are still wondering where we're getting these figures, budgeted profit is simply get the budgeted units, the production, and also multiply by the standard what? The standard profit. This guy here. So that we have our figure. Then the next thing we do, we bring in the sales variances. Have you seen? So our sales variances, there are two sales variances. We've got number one, we've got price. And number two, we've got volume. What was our price variance? We just worked it out. Our price variance, it was an adverse variance of 1,400. And then the volume variance was also an adverse variance of how much? 1,500 adverse. So what happens that we add these two variances because they are both adverse variances, we don't list them, and then we bring the total here. What is the total of these variances? It is 2,900 adverse. You see? So it's an adverse variance. Have you seen? Our contribution went down from what it should have been by this much. Have you seen? So what do? We remove this guy from the planned profit so that we get our 27,700. Yes. So that is the figure which we are going to work with to remove our costs. So now let's deal with the cost what? The cost value. So that is our actual sales. So this figure we are simply going to say our actual sales, let's say minus our actual sales minus, let me just write the word minus in case, minus the standard. Minus the standard cost of sales. Okay, so there we have our cost variances here. We remove our cost variances. So in the exam, just be a bit quick. Remove the cost variances there. Variances are so sweet, they can make you lose out on time. So there we go. So our cost variances, we're going to have two sides. We are going to have the adverse side here, you see. We have the adverse side, and then we're going to have the favorable side. So what is our material price variance? We're doing material. So material, we have two variances on material, you see. Material, we have two. We've got price, and we've got usage. How much is our price for material? The variance? Let me even say these ones are kwacha. These ones are, yeah, kwacha. How much was the price for material? Check your answers for
600.
material. 600. Favorable adverse?
Adverse.
Adverse 600. Price, the usage, I remember the usage was
500.
500 favorable. I am free. These are free marks, so you're just posting now. Next, we've got labor. Labor, we've got rates and efficiency. What was our labor rate?
500. 200.
200.
Favorable.
Efficiency to a favorable variance of 3,400. We're simply picking our answers now. Have you seen? You're just putting what we've already worked out. No need to calculate anything here. Just copy and paste. They give you another mark. Many marks actually. Then we have our idle time also on labor. What was our idle time?
1,000.
It's
Adverse.
always an adverse variance. This one is always an adverse variance. Okay. Anything else that we have? Yes, we had our variable overhead expenditure. Have you seen? Variable overheads. Now, variable overheads, we had number one, we had expenditure. How much do we have on expenditure? We also have the efficiency. How much on expenditure?
200. 200.
Adverse. Okay. Then efficiency, it was a favorable variance of 510. Then we go to fixed production overheads, where we had also expenditure, we had efficiency, we had capacity. So let's go. How much do we have there on expenditure for fixed?
4560.
How much? 4560.
4,500.
On expenditure, 4560. On efficiency, it was a favorable variance because it was just like labor. How much was it? 6,290. 6,290. Then capacity, it was an adverse variance. They used they could only contain 8,000 hours instead of 10,200 hours, which gave us a variance of 8,140. 8140. You see? What do you do? You balance off your figures there. Boom. Now take an optima. These are an operating statement. These are free marks. This is where you make marks in the exam. So what is the total when you add these guys here? You add these guys. What is the total when you add these guys? And also the total when you add these guys. What is the total?
The favor of 10,900.
Okay, 10,900. Okay, there we go. We close the book. Next, how much?
The adverse part is 14,500.
14,500. Thank you very much, Madam Emma. Those are good figures. So now what do? We get the difference. What's the difference between the two? The adverse guy and the favorable guy. How much?
3,600.
So the difference is 3,600. Favorable or adverse?
Adverse.
The adverse figure, as you can see, is more than the favorable figure. So what do? We simply remove that figure now. So what I'm gonna do, I'm gonna remove this figure here so that we just continue. So this figure, I'm gonna remove this figure from that number there. How much do we have? If I remove that figure.
24,100.
Okay, we have our 24,100 because I don't have space. I'm trying to work everything here. Anything else that we have there? We are going to also now remove the sales and admin costs. So we have to bring in the sales and admin costs now, also remove them from that. So we see the actual profit they made. So what do we do now? We go and remove the sales and the admin. How much were the sales and admin expenses? 18,000. Have you seen? Remove those costs from that figure so that you come up with a real profit. So we remove from this figure, we remove the 18,000. How much do we have?
6,100.
We have our 6,100. Have you seen? So that is the actual profit. So our actual profit is 6,100. I've done everything here because I didn't want to go to the next page so that we just see what happens. Mamona. So all you do in the exam, simply get all the values that you've worked out. Favorable adverse, get the difference, remove from this guy. And then you also remove the what? Remove the selling and admin expenses. Then you have the actual profit. So now how do you reconcile? So how you reconcile, you do this. You now check here. You check, number one, you're going to check number one, or you check, you simply get the actual figures now from the question. So in the question, we've been given things. We've been given the sales, we've been given the materials, we've been given the labor, we have been given the variable overheads, we have been given the fixed overheads, and we have been given the sales and admin. Have you seen that? In the question, we've been given those figures. So what do? You check. So how do you check? You got the question, you get this. What was the sales figure in the question? All you have to do is go and pick on the figure from the question now here. You don't waste time. Now you go. Sales were told it was they sold for how much? 95,600. Look at the material variance, 98. Labor variance, 16,800. Variable overhead was how much? 2,600. Fixed was 42. Selling and admin 18. Simply copy and paste. Don't even think twice here. Here you're moving like an ambulance. So what were the sales? We get our sales figure. How much?
95,600.
95,600. And then what were the costs for material? Cost for material? 9,800. There we go, 9,800. Cost for labor? 16,000.
6,800.
Variable overhead costs, these figures are given in the question 2.6. What are the fixed overhead costs? They are given how much? 42,300.
300.
So that means actual cost was how much?
18,000.
18,000. So you add these guys and then you come and remove. The total of these guys is about 89,500.
89,500.
You remove from this guy there, and then you have your profit of how much? Of 6,100. So that means you've reconciled. Have you seen? So the actual profit, was that figure there. So must study reconcile. For to study reconcile if under marginal costing. So an operating statement is a regular report for management of actual costs and revenues, usually showing variances from budgets. That's what it is. So now let's go to the operating statement using AC. Are we okay here?
Yes.
Very okay.
Okay, thank you very much. So we can go now. The next one we are doing now MC. Have you seen? Now using MC here, the operating statement using MC, things are going to be a bit different because under MC we are going to use the standard what? The standard contribution. Have you seen? So we're going to say standard what? Going to use the standard contribution. So how do we got the standard contribution? We simply get the budget. Out of the budget, 5,100 units multiplied by the standard contribution. Have you seen? So if you look at the costs, the question there, the cost card, what's our standard contribution? Not profit. See, our standard cost is this guy, 14,000. Have you seen? 14 kwacha per unit. So to get our standard contribution, we simply get selling price minus variable costs only. 1, 2, 3. We exclude the fixed costs. So how much are we getting if we do that? How much are we getting if we get this selling price? Okay. Contribution is equal to selling price minus variable costs. So selling price is 20. So we have our 20 there. We remove 2, we remove 4, we remove 0.6. How much is our standard contribution? Can you tell me the figure? How much? How much are we dealing with? How much?
13.4.
13.4. If you multiply this one by 5,100 units, how much is the standard profit in that contribution in total?
68,340.
Very good. So that's how you do it under marginal costing principles. These are free marks in the exam. So we get our 68. 68 how much? 3, 4. Have you seen? Yes. Now here, also the volume variance also changes. Have you seen? So we're going to bring in the sales variances here. Now the sales variances, we are going to have 2. Have you seen? We have price, and then we have volume. Now what will happen that the price variance remains the same. The price variance remains the same. So our volume variance will now change. Volume and price. Our price is still at 1,400 kwacha. At this, our volume variance now will change because now we are going to use the standard contribution to get the volume variance. Remember, we got the volume variance by first. So how do we get our volume variance? We're going to get the by the production was how much? Was 5,100 units. If to sanga volume variance kwa kunma mwayabuksha? Yes. So we got those budgeted sales volume of 1,500 units multiplied by the actual sales of 4,850. We had 250 units at base. Have you seen? We had our budget production of 5,1, and then we had our actual production of 4,850. We had the 250 adverse variance. You see? So what we did here, we multiplied this by the standard profit of 6. Then we got our, how much? Our 1,500 adverse. This time things have changed. We get our 5,1, then our 4,850. Then what do? We get the difference of 250, which is still the same, but this time around we multiply by the standard profit. Standard contribution, how much? 13 point what? 13.4.
13.4.
So how much is our variance this time?
It's 3,350.
3,350. So we have about 3,350. That's the only difference, the volume variance. So what do? You bring that variance here. Don't even stress. 3,350 adverse. You see? Now take an umtima. Pourquoi you worked out that one? You are even happy. You're even getting a bubble gum. You are chewing a bubble gum in the exam, and even remembering. Yeah, they are allowed to go with a bubble gum in the exam. You can chew. So what is the total there? The total is simply 4,750 adverse, which means we are removing from that figure. So how much do we have now? Now we have our
590.
590. You see? So what do we do this time around? We bring the same things there. So this is the same figure. What did we call this figure? We simply said actual sales minus the standard variable cost of sales. So what do? We bring our variable cost variances. Remember, there we brought what we call the cost variances. Now what we are going to bring this time, we are calling it variable. Have you seen? Variable cost variances. Because we don't include what? Fixed cost variances in this statement. So we have, there we go, as usual, we have our material. Material, we've got price, and we've got usage. Then there we go, not quarter 2, we've got adverse there, and we've got our favorable there. So what was our material price variance? The same thing, with just copying and paste, 600. You see? Favorable, how about adverse 600? This usage was 500. You move on, you go to labor.
Ready?
Labor, you've got rates and efficiency. What was the labor rate? The labor rate was 200. Then the efficiency was 34. About you're even happy, you go to idle.
1,000.
1,000 harvest. And then you go to variable overhead expenditure. So variable overheads, you've got the expenditure. What was the expenditure variable overhead variance? 200. Adverse. And then the efficiency?
510.
510. We want to work them out. There you even close your books here because you don't want to waste time. You close your books. Don't include fixed costs. Have you seen? So what is the total when you add these guys here? What is the total and when you add these guys here? Somebody help with the total. What is our total? Total.
The favorable part is 4,610.
Okay, 4,610. Then the adverse part?
18.
18.
18. Okay, so there we go. So what is our difference when we bring that? We bring this figure somewhere there. So that we, what's the difference?
2810. 2810.
So we have about 2,810. Good. Favorable adverse?
Favorable.
Favorable. So this means that we are not removing, we are adding. Have you seen? On that guy. How much do we have when we add? How much is our figure?
66,400.
Okay, so now what did we say? We said we bring in. What do we bring in? What do we bring in?
Sales and the admin.
Okay.
Mhm.
Here we are not going to bring in what we are talking about. So here we simply bring out the actual contribution. So we can now work out the actual contribution, and the actual contribution now, this time around, we are going to have something like this. Let's say actual contribution. What will be our actual contribution? So we're going to get the budgeted, which is the planned fixed production overhead. What was the planned fixed production overhead?
Was 37,000.
Okay, so the planned fixed production overheads was how much?
37,000. 740.
740. Okay. And then we removed, remember, we moved the expenditure variance. Have you seen? How much was our expenditure variance?
It was 4,560.
Adverse. You see? We are simply copying and paste what we did. So how much now do you have when you remove that figure? You have 42, 300.
42,300.
Yes. So now, if you get this 42,300 now, this figure, you remove from what we found already. How much have we found? We found 66,400. When you remove that figure, how much are you remaining with? Punch up.
Here are we adding or subtracting on the?
We are now subtracting.
On the 42. I've
Yeah,
seen
we're
you
removing
then.
the 42 from the 66.
Okay.
The 42 are removing from the 66. It's a cost, it's an expenditure. How much do we have when we remove?
24,100.
Yes, 24,100. Have you seen? Now we can now bring this figure, the sales and what? And admin. How much was it?
18,000.
18,000. So now we remove the 18,000 from the figure. How much do we have?
6,100.
You've reconciled. Easy as drinking water. So here, notice that the actual profit is the same as the profit calculated by the standard absorption costing because there were no changes in inventory levels here. Have you seen? Absorption costing and marginal costing do not always produce an identical profit figure like the way we've done it in here. You see, they don't always produce an identical figure as we have done it here. You see, but the reason why we have this identical figure here, the actual profit, is because there were no changes in inventory levels. Sometimes we're opening inventory, sometimes we're closing inventory, sometimes whatever it may be. So you must be able to understand that it is not always the same. Sometimes the figures are different. But most students, they get confused on this figure here. But they forget. Don't forget this part. Don't forget. Yeah. Okay, so let's talk about the differences here. You know, before you can investigate a variance, there are some of a few things that we can talk about. You know, let's talk about a few things and the standards that are there when it comes to variance analysis. We can talk about a few standards here. We have about a few minutes to go. Professor, are we safe?
Yeah.
Okay, good. So let's talk about, sometimes the examiner asks the question, say, explain what should be done before the company can decide to investigate a variance. Have you seen that? So before you can decide to investigate a variance, decide what to investigate a variance, here you say, decide whether to investigate variance. So before you can investigate a variance, there are things you must consider, because sometimes variances are interrelated. Consider what we call materiality. So those of you who are doing auditing, you know materiality concept. Yeah. So consider materiality number one. When we say materiality, we mean that you have to consider the significance of the variance. Have you seen? Small variations in a single period are bound to occur, you know. There could be small differences here and there. Have you seen? So just look at the difference. Is it, if you have a difference of, let's say, $1, can you go and start investigating why there was a difference of $1 or 1 kwacha? No, it is too small. And then the other thing you can look at is controllability. Before we begin to investigate a variance, see controllability. By controllability, we mean you tend to establish where the difference was caused by the operational variances, by the operational or by the planning. If it is planning, then you know you have no control because it's according to the market environment, market conditions. Is it internal cause for the variance? Can you control it? Have you seen? Can you control it? Is it internal cause? Are we able to control the variance? You see? If we're able to control the variance, then well and good, we can see and control. But if we can't control, just let it be, because it's uncontrollable according to the market conditions. And then the other thing you may look at the variance trend. Look at the trend. This trend of yours, you know, some parents have got a way of telling a child who does not listen that you have this trend of yours to show you that you have a pattern of doing things which is not nice. Have you seen? A pattern has been going on for some time. So here, if say an efficiency variance is maybe let's say just 1 million at best in 1 month, the obvious conclusion is that the process is out of control and corrective actions must be taken. This may be correct, but what if this same variance has been happening every single month? Let's say every month you have had this variance of how much? Of 100,000. Every month, 100,000. So this means it is a trend in your company that you have this variance. You expect to have 1,000. Have you seen? So the trend here indicates that the process is in control and the standard has been wrongly set, whatever, blah, 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 blah. So think about the trend. And you can also think about the costs. Because you don't just wake up and say you're going to investigate a variance. What are the costs involved? When we say costs, think about the likely cost to be involved in investigating. Is the cost outweighing the benefit? Have you seen? If the cost of investigating is more than the benefit, then just leave it. You see? If the cost is more than the benefit, then you can just leave it. And then lastly, but not the least, you can talk about what we said, interrelationship. Interrelationship. You see, interrelationship. Is that the way you write interrelationship? Okay, not so bad. Okay. When we say interrelationship, here is that is what we talked about. We said interrelationship has got to do with one variance being caused by another variance. Like we talked about earlier, where if you buy cheap labor, you bring in cheap labor in your company, there's a higher chance that that cheap labor will cost you on material usage because they're incompetent guys who don't know what to do, and then they end up misusing the material. So sometimes before you investigate, look at the variance. Is this variance as a result of my previous variance or my previous decision? So that you know where to control. So if it is in the relationship related variance, just bring in somebody competent and then the difference will be eliminated. So those are some of the things that you should think about. However, I have an assignment for you before you go to planning and operational variances. I would like you to look at this one here. We are going to start immediately from this session. We'll start planning and operational, and then we're going to move on to mix and yield. So I need you to look at these 4 standards that are available. Have you seen? I need to look at the performance standards in terms of variances. Number 1, you should be able to write things on number 1. I need to find out on the ideal standards, types of standards. So I'm just giving a type of standard is what we call ideal. And then number 2, there's what we call attainable. Attainable, I need to find out these guys, find out what you can about these guys. And then number 3, I need you to find out on what is called the current. And then last 3, I need you to find out what is called the basic. Now here, since the idea, the whole idea of you finding out about these 4 guys, I want you to be able to tell me their effect in terms of employee motivation, because that's what the examiner loves. He loves linking these types of standards to their impact on employee motivation. So you, as you study, find out their impact to employee motivation, because some of them have got an adverse effect on employee motivation, if not most of them. So find out and put in writing. I'll be able to look at it. So we can now move on to something called planning and operation variances.
Okay.
Mr. Mfune, are we okay?
Very much okay. Very much okay, yeah.
Good. Mr. Garcia has just left us. He's saying that the network is bad. Actually, even me right now, my network is not okay today because of the weather, maybe because it is cracking when I'm writing, which is because of the weather. So, Professor, are we safe?
Yeah, safe.
Okay, thank you very much. So, see you in the next video. Those who are watching us online, we are going to mix and yield and then planning and operational variances, or whichever we start with, it's okay. Bye. Bye.
Morning, kutoka
Bye.
New York, coordinator in Tisiza,